If you are a real estate investor, there is one decision that quietly affects your entire portfolio, but most people don't think about it seriously enough. Who is handling your taxes? Not just filing them, not just submitting forms on time, but actually understanding your strategy. Because many investors assume all accountants are the same. They believe that as long as the numbers are entered correctly and the return is filed, everything is fine. But over time, something starts to feel off. The tax bill seems higher than expected. The strategy feels unclear. You are not quite sure how your numbers are being calculated. And that is when the real question shows up. Is your accountant just filing your taxes, or are they actually helping you build a strategy? In this video, I want to break down the real difference between a general accountant and a real estate-focused CPA, and why that difference can directly impact how much tax you pay over time. Let's start with what most people experience first: a general accountant. General accountants are not bad. In fact, many are highly competent. They work with a wide range of clients: small businesses, employees, freelancers, families. They understand tax rules, deadlines, and compliance requirements. And for straightforward situations, that works perfectly fine. If your income is simple, your deductions are standard, and your financial structure is not very complex, a general accountant can handle your return without any issues. But real estate investing is not always simple, and that is where the difference begins. Let's talk about perspective. A general accountant typically looks at your taxes once the year is over. They gather documents. They organize the numbers. They file the return. Their job is to report what has already happened. A real estate CPA, on the other hand, approaches things differently. They look at your properties as a system. They ask questions like, how many properties do you own? Are they long-term or short-term rentals? Have you refinanced recently? Are you planning to acquire more properties? What is your exit strategy? Because real estate is not just about income, it is about timing, structure, and long-term planning. Now, moving forward, let's talk about one of the biggest differences: understanding of real estate-specific strategies. Real estate comes with unique tax opportunities: depreciation, cost segregation, passive activity rules, material participation, 1031 exchanges. These are not minor details. They are core elements of how real estate investors reduce taxes legally. A general accountant may be aware of these concepts, but a real estate CPA works with them regularly. That means they do not just recognize the terms, they understand when and how to apply them based on your specific situation. And that difference matters, because applying a strategy incorrectly can be just as costly as not using it at all. Now let's talk about something investors often overlook: timing. Real estate tax strategy is heavily dependent on timing. When do you purchase a property? When do you place it in service? When do you make improvements? When do you sell? These decisions affect depreciation schedules, capital gains, and overall tax exposure. A general accountant usually enters the numbers after the fact. A real estate CPA helps you think through those decisions before they happen. That shift from reactive to proactive can significantly change your outcomes. Now, let's shift into structure. As your portfolio grows, your entity structure becomes more important. Should properties be held in one LLC or multiple? How should partnerships be structured? How should income flow between entities? These are not just legal questions, they are tax questions as well. A general accountant may not focus deeply on entity structuring for real estate portfolios. A real estate CPA evaluates how structure affects liability, taxation, and future flexibility. And this becomes even more important as you scale. Now let's talk about something practical: communication. Many investors feel that their accountant only appears during tax season. They send documents, they receive a return, and that is the extent of the interaction. But real estate investing involves decisions throughout the year: refinancing, renovations, acquisitions, sales. Each of these has tax implications. A real estate CPA is more likely to engage in ongoing conversations, not just to file but to guide, and that ongoing communication can prevent mistakes before they happen. Now, let's address a common assumption. Some investors believe hiring a specialized CPA is more expensive, and in terms of fees, that may be true in some cases. But the better question is not, what does it cost? The better question is, what does it save? If a more informed strategy reduces your tax liability, improves your structure, and helps you avoid costly mistakes, the value can far exceed the fee difference. This is especially true as your portfolio grows. Let's also consider complexity. When you own one property, things may feel manageable. When you own multiple properties across different markets, with different financing structures, possibly different partners, complexity increases quickly. At that point, having someone who understands real estate specifically becomes less of a luxury and more of a necessity. Now, this does not mean every investor must immediately switch accountants, but it does mean you should evaluate whether your current setup aligns with your goals. Ask yourself, does my accountant understand real estate strategies in detail? Do they discuss planning with me before year end? Do they help me think through future decisions? Or do they simply file what I give them? Those answers will tell you a lot, because at the end of the day, taxes are not just about compliance. They are about strategy. Real estate investing offers powerful opportunities to build wealth, but those opportunities are closely tied to how your taxes are handled. The right advisor helps you see the bigger picture. They help you connect your properties, your income, your timing, and your long-term goals into a cohesive plan, and that is what ultimately makes the difference. If this video helped you think differently about the role of your accountant, subscribe to our channel. We share weekly insights designed for real estate investors who want more than just filed returns. And if you want to learn more about how a real estate-focused CPA approaches tax planning differently, visit gavtax.com for deeper insights and resources. Thank you for watching, and I will see you in the next video.